Welcome to Everyday Economics. I'm your host, Chris Krug, president of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can hear all of our terrific podcasts at americastalking.com. To support Everyday Economics and podcasts such as this one, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording today's episode on Friday, September 15th. Dr. O, what is going on with the consumer price index? This came in a little bit hotter than I think some people thought it might. Gas prices certainly not helping.
Yeah, I think headline inflation increased in August. Core inflation actually eased, and all of the increase, most of the increase at least, came from energy prices. And so you have 3-month annualized core CPI rate at 2.4%, which is not too far away from the Fed's 2% target. And so I expect that to continue. But of course, you have those volatile components of CPI, food and energy, that are going to surprise from month to month. I think the Fed should look past the noise and focus on core inflation and look at it and see where that's headed, right? So if core inflation starts to pick up again, then yes, we should, the Fed should maybe tighten a little bit more. But as of now, I think, the numbers that we're seeing are indicating that core is going to continue to head in the right direction, and that the Fed should probably skip another rate hike next week. Wait and see. A lot of businesses, especially your middle, smaller and medium-sized businesses are already feeling the squeeze, and that's likely to continue to slow the pace of employment growth, hiring, the pace of hiring, and continue to cool the labor market.
I mean, fuel prices are just so important to the economy as a whole. I mean, it's not to say if I were the president or if I were in Congress, I would make it my top priority, but I would think that I would be wanting to make it my top priority, regardless of what public office I held, because there's just so much connectivity there. I mean, just sort of looking back at the numbers, I mean, just to kind of make sense of this, right? And I'm taking this straight from Forbes, which did some reporting on it. So the energy CPI fell year on year, 3.7%. between August 2022 and 2023. However, between July and August of this year, it's gone up 5.6%. So what is it that we are or aren't doing that is having this influence on fuel pricing at this point? What's the connective tissue here that we need to understand?
Well, look, it really, so the impact of oil prices, right, is really depends. It's not, it depends on whether or not a country is a net importer or net exporter of oil, right? So if prices are rising and you're a net exporter, then you might actually be okay. In fact, you might be very happy. But again, the impact of oil in terms of monetary policy is really going to depend on whether or not the higher oil prices were caused by an increase in demand, right? A demand shock, or by an unanticipated decline in supply. And in this case, it's mostly because supply has gone down. You have Saudi Arabia, the world's biggest oil exporter, cutting output. You have the problems we're seeing in Russia and other oil producers around the world, right, due to political, geopolitical turmoil. And so in this case, the kind of supply shock is likely to result in, is not going to cause wages to increase, right? And is actually going to squeeze households and businesses. It's going to squeeze pocketbooks really hard. You add to that the fact that you're going to have the student loan repayments, and that you already have yields going up across the board that are tightening credit for households and businesses. And basically, you have the conditions for a slowing U.S. economy. Mm-hmm. And so that is why this energy issue is quite significant.
Let's go back to something that you were talking about. I think I might have just sort of slipstreamed this and didn't really let you amplify on it. So the Fed rate. I mean, I've had conversations ongoing about what's going on with the Fed and whether they would be, looking to make an increase. Of course, there was, not to say like a minor panic around it just a couple of weeks ago, but there was something resembling a minor panic a couple of weeks ago that we were headed toward another increase. You're looking at this data, you're still thinking we probably will see a pause for the meantime?
I think they should. I think they should pause for all the reasons I just highlighted. Now, whether or not they're going to do that, I'm not sure, right? But I think they should pause. There's a lot of there are many headwinds, right? Currently, right now, especially with the energy price increase, is another headwind, right? There's nothing the Fed can really do about that. It's kind of out of their hands.
Right.
So, and that's going to slow American consumers. Then, of course, then again, some people will point to the fact that labor productivity has moved higher, that household incomes and household wealth have increased in the past year, right? And that could also stimulate some spending, right? So those would be tailwinds. And so you have these factors that are kind of like working together, and I guess we'll have to wait and see which of these effects is going to be larger. For the consumer. And again, that is exactly why, this wait and see, I just said wait and see. That's exactly why the Fed should also wait and see whether or not, the impact of the negative impact is going to outweigh the positive impact on consumers, and to figure out where the economy is headed. But I think at this point, most consumers are close to being tapped out. You have interest rates are high and likely and rising, still rising.
Yes, right.
Interest rates are high and rising, and consumers are being squeezed. The good news is that supply is coming up. Supply has been increasing. I like to think, and I've mentioned this on the podcast before, I like to think of wage growth. Wage growth has been slowing. And so wage growth kind of proxy for demand, for the demand side, right? The higher, as your wage increase, the higher the wage growth, the more you spend, right? And on the other side, on the supply side, labor productivity and employment growth, right? The fact that productivity has been rising again, the fact that employment's up, right? A proxy for real GDP, the supply side of the economy, right? And as long as real GDP and the gap between real GDP and nominal GDP shrinks, inflation is coming down, because that's ultimately the math, right? Inflation is really the gap between nominal GDP and real GDP. And so I continue to expect inflation to cool. And the good news is that it doesn't have to cool from battering demand because supply is increasing, to kind of close the gap and restore the balance. So that's where I see this going. I think that the Fed should wait and see, because if it doesn't, it might end up missing the runway altogether, like it has historically.
Yeah, I appreciate your thoughts as always. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics at americastalking.com.